Hi, my name is Dave. In this video, I'll be covering on the long call vertical. Long call vertical is also known as buying call vertical options contracts. Let's move on to find out more. Boyer spotted a potential trade where the stock price is expected to go higher. He would like to capture some profits from this upwards move. But he does not want to pay so much for the options price. He wants to minimize time value. He is entering a long call vertical to ride this upwards momentum with a lower options price. When a trader creates a long call vertical options position, the trader is expecting the price to move to the upside, but the trader wants to pay for a lower option price by minimizing the time value in the option price. From this diagram, you are able to see lower stock price, current stock price, and higher stock price. For longing a call vertical, the trader would expect the stock price to move from the current price to a higher price. If the price moves from the current price to a lower price, the trader will experience a loss in the trade. Similar to a long call vertical is a debit play as the trader needs to pay for the call options contract. Thus, the option price that the trader has paid for is reflected in the diagram. Do note that long call vertical minimizes the time value in the option price, and thus the overall option price is much lower. Now, to make a profit on this call options contract, the trader needs the price to move more than the option price that he has paid for, as seen in the green arrow. If the current price did not move more than the option price, the trader will start to experience losses, as seen in the red arrow. Time decay for a long call is minimized, as there is not much time value in the options price. Profit potential for a long call vertical is limited. No matter how much the stock price goes up, the call options will have a profit limit and does not go further from there. Maximum loss for a long call vertical is limited. The maximum loss for a long call vertical options contract is the amount that is paid for. Next, let's look at what is the composition of a long call vertical. It is basically made up of two option contracts, also known as two-leg option strategy. The first option contract is a buy, stock name, expiration date, strike price, call option at a certain contract price. The second options contract is a sell, stock name, expiration date, a higher strike price, call option at a certain contract price. For example, buy XYZ company with December expiration date with strike price $45, call options at option price of $3. And sell XYZ company with December expiration date with a higher strike price at $50, call options at option price of $1. Thus, the overall debit option price is $3 minus $1, which is $2. Let's perform the execution of this strategy in TDAmeritrade Platform and also Tastywalks Platform. Do note that TDAmeritrade Platform is also known as thinkorswim Platform. Let's start with TDAmeritrade Platform. This is the TDAmeritrade Platform, also known as thinkorswim Platform. Let's say I will expect this particular stock to go higher. So I decided to long a call vertical options contract. First, I'll go to the trade tab. Next, I'll go to the option chain. I would like to ensure that the spread selection is vertical. In this case, I want to perform a long call vertical strategy, which is buying call vertical options contract. I would like to give it some time for the trade to play out. So I choose 20th October expiration date. Do note that the left side of the screen shows the call options contract and the right side shows the put option contracts. Let's focus on the left side of the screen for the call vertical options contracts. There are two legs to choose from for the long call vertical strategy. I would like to capture profits from $35 to $40. Let's click on the $35 and $36 call, then I'll adjust from there. Click on the ask price of 59 cents. This will bring up the order screen. As you can see, there are two legs in this order. One is a buy order, the other one is a sell order. And they have a quantity of 1, and the symbol is eBay, and the expiration date is 20th October. Strike price is, for the buy side would be $35, and for the sell side I want to change it to $40. And the strategy type is call. And the option price that I'm going to pay for is $1.86. This is a limit order with TIF as day. Also note that the row is colored green to highlight that this is a debit order which you will pay for opening this order. Let's say if I were to do a long call instead of a long call vertical, the option price will be different. Let's take a look at the long call at strike price $35. I'll change to single. Take a look at the 20th October as well at $35. As you can see, it's $2.55 as compared to the vertical price of $1.86, which is lower. So, long call vertical strategy has a lower option price as compared to long call strategy. Once you are done with the adjustments of the order, you can proceed by clicking confirm and send. You will be brought to the confirmation screen. However, before you proceed, you may want to check on the potential profit and loss levels of this trade. You can do a right click and do an analyze trade. And you are now in the analyze tab. Make sure you click on the risk profile and see what are the profit and risk areas of your trade. The current price is $35.55. The break-even price is $36.86. So, in order to make a profit, the stock price needs to go above this level, above $36.86. If the stock price did not manage to move above this level by expiration date, the trade will make a loss. Take note of these profit and loss levels. Max loss is what you have paid for, which is $1.86, which translates to $186. Do note that the max gain is when the stock price hits $40. That is your max gain. If all is fine, you can go back to the trade tab. Once you are done with the adjustments of this order, you can proceed by clicking confirm and send. You will be brought to the confirmation screen. Check the information. If everything looks good, click send to submit the order. This is how long call vertical is being executed. Next, let's go to the Tastywalks platform. This is the Tastywalks desktop platform. Over here we can see the chart screen. Let me go to the watch list and click on eBay. I want to perform a long call vertical strategy on eBay as I'm expecting it to go higher. First, I'll go to the Trade tab. Next, I will go to the list of option strategies. I will choose long call vertical strategy and click go. And here I can see two legs, one buy leg and one sell leg. And let me expand it bigger. Okay, now I would like to change the strike price for the buy leg to strike price of $35. And for the sell leg, let me double click on the sell leg. I would like to change it to strike price of $40. So as you can see here, I can choose to adjust the strikes via this option. Okay. Once I'm done, I can choose to change the quantity of the contracts. In this case, I'll leave it as quantity of 1. And for the expiration date, I would like to adjust it to October. Let me adjust the expiration date. Now currently is seen as June. Let me move it to October. Let me start to move it upwards. Okay, now is October expiration date. Do note of the maximum loss, which is $186, and your maximum potential profit, which is $314 if this trade plays out well. Once all the adjustments are done, you can click Review and Send. You'll be brought to the confirmation screen. Check the information. If everything is good, submit the order by clicking Send Order. This is how long call vertical is being executed. Thanks for watching this video. You can watch more free videos at WhaleTrades.com.